in the Birmingham, Alabama market to see whether or not it is a cash flowing property for Section 8 rental purposes, right? It's long term rental. And just in case you guys have not seen the podcast I've done on Birmingham, I had a really good podcast with Daisy Sebastian. We talked about all the top properties, top markets, highest in demand areas in the Birmingham, Alabama market. And it's going to be really, really good for you to just check it out. So that's why we're in this area today. Now, one more note. We just released another podcast today with Michael Eaton, and this is going to be so good for you to read if you are ever thinking about starting your own nonprofit. And I know that so many of you watch this channel because you want to make an impact with your time, your energy, your resources. So that's why we made it just for you. All right. Now that we got this property here, let's see where this is. This is right in Hueytown, which is one of the top markets that Daisy recommended for families. And you can see that this property, it is, I can't tell if there's anything wrong with the windows or anything like that, but it looks relatively turnkey for the most part. So it doesn't look bad. I mean, I would definitely replace the fridge. This fridge looks like it's from a horror movie. I mean, it just got a weird vibe to it. Yeah, it's like yellow. Or maybe it's just lighting. I don't know. But yeah, I would get rid of the fridge and replace that. The room looks okay. I just can't tell whether or not the windows need any fixing or repairing, or make sure that the screen's there in place. All right. So this is a 3 bedroom property. It's 1 bath. Is that another bath? Oh no, that's just staged. Okay, I can't see the half bath here. Oh, there it is. That's a half bath. All right. So 1.5 bath, 2 toilets is always better than one. All right. So this gives me a couple items to look up. Now, this property is listed for $130,000. So I'm going to go to my spreadsheet. And again, if you guys want to copy the spreadsheet to follow along, just go to affordablehousing.io, not .com. Go to the Get Deal Analysis tool. That's the fastest way to be able to copy the spreadsheet. Same here. This is the one I use to analyze all the long-term rental deals. All right. Again, this is not investment advice. I'm not soliciting any investments on this call. Just simply showing you all the process to go through to figure out what does a deal look like, quote unquote, for you and your own target return, right? Your own circumstances are going to be very different than anybody else. You have different goals. All right. So now that we talked about that, the next factor we want to look up is the rent. So you got to get 2 data points in order to get your rents. The first one I always go to is affordablehousing.com. I go to the owner section. I go to the market rent estimator. I plug in the address and plug in bedroom count. And I can see right here that for 24 units within a 2.48 mile radius, the average rent is $13.78. Great. I'm going to assume it's going to be right around there. However, there is another number that typically people look up. This is called the FMR, the fair market rents. And I'm going to go to at Google HUD FMR. I'm clicking the first link, and I'm clicking on access to small area FMRs. And now I'm going to click on look up FY 2025 small area FMRs. When you click on Alabama and you look up, I think this is Jefferson County, and you look at the zip code, it's 35023. So now you can see that in 35023, the rent ceiling, quote unquote, the fair market rent is 1600. Okay, so we're gonna put 1600 right here, and then 1280 for a 2 bedroom. Great. This is green 3 bed, 35023. SAFMR. Great. That's a 2 bed. And I'm writing down all these numbers because my partners already know how I analyze deals. So this is the easiest way for them to kind of figure out, okay, what was Kent's research? And if it's a deal, I can just kind of send it right over to them, right? This is for a 3 bedroom. Let me fix that. Great. And my average rent, I take it right from here, 1378, 1595, they're 1239, and 1285. Great. So I have a 3 bedroom in this area as a rental, and I've been getting about 1250. So this property's at 1370, so it's a little bit higher, which makes sense because the people said it's more desirable. Now, the mistake that some people make is that when they look up the SAFMR, the 1600, usually that SAFMR includes utilities. So if you don't provide utilities, usually you have to deduct it. Now, there are exceptions to the rule, but in general, This is the rent ceiling. And in general, there's a test called the rent reasonableness test. The rent reasonableness test means that you are essentially have to take the lower rent of the two, right? And let me show you in this guidebook here. What I'm pulling up right here is called the Housing Choice Voucher Program Guidebook. HCV is what was previously known as Section 8 vouchers. So if you go to Section 2.2 for this guidebook, right, they rebranded it from Section 8 because of all the negative connotations associated with Section 8 to Housing Choice Vouchers. You can see that right here. It says, in conducting rent reasonableness, the PHA, or the Public Housing Authority, must determine whether the rent to the owner is a reasonable rent in comparison to rent for other comparable unassisted units. So in determining comparability, the PHA must determine these factors, right? So obviously the size of the unit type matters, right? You got to compare single family homes to single family homes. So in this scenario, you have to pay the lower of the two because you can't charge more rent to someone simply because they are a voucher holder, right? For the obvious reasons. So I have to use 1378 for my rental assumptions here and not 1600 because this is the more reasonable rent, unless you have other supporting evidences, such as we were talking about Greensboro, North Carolina, the last couple of times, and you saw that, hey, we actually got above slightly the payment standards. And that might change, right? With all this funding changes that is going to happen because of the cuts to the new big, beautiful bill. You're going to see different changes, right? I'm not taking any sides on politics of this. I'm simply sharing with you what's happening and how might you want to react as an investor, right? Not investment advice, so that you can figure out, hey, how do I protect myself against this? Because I think all investors have a duty to be diversified in how they look at a portfolio, and more importantly, how to protect against downside risk, right? It's just a very, it's like a Warren Buffett principle, right? You don't want to lose 50% of your portfolio because then you have to make 100% just to catch back up. It doesn't make any sense. It's much harder to recover from a devastating loss. So let's keep going with this deal. So this property is relatively turnkey, but I'm going to make some renovations here. So I'm going to go to my rehab calculator spreadsheet right here. I'm going to put in about $1,500 for the roof, just in case there's any patchwork that needs to get done. I've essentially had to do some roof work on every single property that I've ever bought. So $1,500 seems relatively low, but also relatively safe because you got to do something. That's what I find. Now for painting, I'm assuming the painting is done in a pretty decent job, but I'm still going to do about 300 square foot at $3 a square foot to do some touch up paint in case there's something that I cannot see. The floor looks okay, so I'm not touching that here. For my toilets, I'm going to replace the two toilets with high pressure flush toilets. And the reason I'm doing that is because I have high pressure flush toilets at my other properties, and I've never gotten a clogged toilet call. So I intend to keep it that way. All right. Because I don't want my time and energy to be sucked up because of a clogged toilet. It doesn't make any sense. And if you ever get a plumber called out there, it costs you like $150, $200 for a clogged toilet call. Then you have to replace the toilet for $200. I must also spend a $450 upfront and get one of those high pressure assisted flush toilets. That's just my opinion. I'm of the mindset where you solve the problem much more upfront. All right, so we have that piece. Next piece we're going to want to do is install a cage for the HVAC. I've had an HVAC unit stolen. Huge mistake. Cost me $5,000 to replace that. When a cage would have cost me $900. So lesson learned, never making that mistake again. Great. Now that I got all these numbers in here, I got about $5,000 rehab on $130,000 property. Not outrageous. Let me delete this, multiply 4 because that was the scenario that we looked at 2 days ago. All right. So now let's get my taxes and my insurance. So if I go to my Redfin calculator and I go to my payment calculator here, I see that the tax is 128, insurance is 101. I'm plugging 128 right here. And I'm going to do 1 equals in my home insurance 101 times 1.2. And I'm multiplying by 1.2 because I'm assuming that there is a premium that insurance companies typically place on investment properties. That's why I'm multiplying by 1.2. All right. For my maintenance and my war chest, I'm going to bump this up to 10%. It was at 5% earlier because we're looking at condos. So there's big capital expenditure items that are typically covered by an HOA fee. That's not going to be covered here. So I'm going to zero that out. But I got 10%. And because, look, you know that the roof, the water heater, you know things are going to get break down. They're going to get replaced. And if you don't set aside money right now for those expenses that you know are coming down the road, well, you would be underestimating your expenses and grossly overestimating your profitability. So don't be that person, right? Thinking you made all this money and then 5-10 years you replace your roof and you realize I made no money the last 10 years. Don't be that person. All right. I had 10% for property management. I got 5% for vacancy. Great. So for my down payment, let's assume I'm doing 25% down this deal. And I just closed the deal the other day for 7.875% interest rate. So my down payment is going to equals to my B4 times my down payment percentage right here. That's 32,500. If I buy this property for 130, I have my interest rate right here. My finance amount is 97,500. I got 3.5% for my closing costs. I got $5,000 for my renovations. So if I buy this property using 25% down, financing 97.5 grand, I am now financing at 7.875%. So if I rent this property out as a 3-bedroom for 1,378, right, not 1,600, I'd be cash flowing $77 a month. That's a 2.2% cash on cash return, assuming I bought this property for 130 grand with $5,000 rehab, 25% down, and 7.875% interest rate. Now, let's say my target return is 8%. Right? What do I need to lower my asking price by in order to achieve an 8% return in E9? Well, if I go to 100 grand, I'll like, oh, okay, that's a deal at 100 grand. What about 105? 103? So now you might say, hey, maybe I'll make an offer for 103 grand because 7.8 still rounds up to 8%, right? And that's assuming everything else stays constant and you're renting into this property at 1378, right? Now, what if you get better information, right? What if you know somebody in the market that's getting 1,400 for a 3-bedroom here, or 1,450? Let's bump it a little bit and make it interesting, right? So now all of a sudden, that number just jumped up. So now you might be willing to pay 111. That still rounds up. So that's a difference on meeting your target return, right? 7.7. Because now your cash on 235, but your rent jumped up just by about $75. Your rent jumping up by $75 allows you to pay, quote unquote, $8,000 more for a deal. And then this is why I'm emphasizing this, because you get to figure out what is a deal for you and how quickly can you adjust with information that you get to make this a deal, quote unquote. Okay. Huge difference. 7.8, that was 224. Just getting my numbers down there. So let's stay at 1450, right? If you know other investors in this market, or you talk to your property managers, right? How do you get information to give you supporting corroboration details, if you will, about how do you estimate the rents? And asking a property manager, especially the ones that are processing the rent increases right now, that might be it. But you might be conservative. You might say, hey, I think, and again, I'm talking about 5% vacancy. I would not lower that anymore, especially if there is a new requirement for HUD, especially if people had to move out every 2 years. You never know what the regulations are. So I just want to be conservative here. I would not lower the vacancy anymore because you know someone's going to move out, right? I won't lower the vacancy anymore because I don't want to underestimate my expenses. I'm not going to lower my property management expenses either because guess what? I'm going to assume I have to manage the property or I have to hire someone to manage the property. And if I don't underwrite with property management expenses, then I'm essentially buying myself a job. And that's not something that we typically get into real estate for. So those are the details for 1450. Now, let me do a couple more scenarios, right? Let's say, and that was 111. That was the scenario, right? Let's say your interest rates drop from 7.875 to 6.875. So it drops a whole point lower. See what happened to my cash on cash return right there? It jumped up to 9.5. So now I might be willing to pay 120. Am I that lucky? Oh, 120. If my rent is 1450, I might be willing to pay 120 just because my interest rates dropped one whole point. And that can happen, right? That can happen overnight because guess what? The interest rates are affected by two factors. One is the interest rate on a 10-year yield, and the other factor is the spread between the 10-year yield, the treasury yield, and 30-year mortgage interest rates. Now, historically, that spread has been about 1.5% to 2%, but it's gone as high as 2.5%, 3%. And you see this volatility. Sometimes you see the spread getting wider as there are more talks about tariff uncertainty, or you might see it narrow when tariff deals gets better, right? Then you might see that Trump is trying to put in a new Fed chair, right? So Jerome Powell has been pretty firmly, again, it's not politics, just reacting to what they're saying. If you really want to listen, just follow Logan Motoshami from Housing Bar. Great guy, stays very objective with the charts. And follow what's happening. Because Logan talked about how when you install a would-be successor to Jerome Powell, that would-be successor can now start going and telling the market, hey, as soon as I get in on May or June next year, I will start lowering interest rates. Okay. Well, now bond traders can get ahead of it. And when bond traders get ahead of it, that's what drives down your yield on the 10-year treasury yield. So you might get half a point decrease right there. Then you might get overnight headline news that says, hey, all these tariff deals are coming to fruition. And that spread can really narrow 1 point overnight. And that's how your buy box might go up from 103 to 120. You might be underwriting 1378, and then you would talk to your property manager and say, hey, I think they might tell you, I think you get 1450. Again, verify your information, get some proof, get some comps. Make sure it's a like for like property. Make sure you're looking at single family homes versus single family homes, and you want to look at the same relative conditions, right? Right. A home that has two toilets will rent a lot better than homes with one toilet. All right. Just remember that. So, and then you get interest rate drop a point. Now it's then your buy box go from 103 to 120. That's a huge difference. Excuse me. So this is important. Please, please, please do your work and stay on top of what's happening. All right. I hope you all had an amazing day. My throat's killing me. So I'll see you all tomorrow for day 648. Have a good one, everybody.